you need to be short small caps, anything that's high debt, high enterprise value. When you look at those ratios, you need to be short basically the Russell 2000. So anywhere 2250 on up to 2275, we look at that as strong resistance point, and we would come in and be active sellers on there. The NASDAQ, on the other hand, with low interest rates, you want to be long organic growth, and the NASDAQ is your perfect hedge on the long side.
But when does that end, Phil? There's convexity to that, right? It works until it doesn't.
It'll end when the economic data says it ends. So you need to stand the course until then. We've gone into a phase transition. That's the way you play it. You also want to be long gold. You want to be short the dollar. You want to be long Swiss franc, Japanese yen, some of these other currencies. The wheat market's a great one of the tightest wheat crops on record.
Okay.
So there's plenty of opportunities out there. You just got to be very selectful, and you can't stay with, these themes and ride them out forever. They're going to change.
So the commodity part, totally on board with. I want to come back to the NASDAQ, though, because that one's really, really important here, because, Phil, one could argue that's been happening, right? If we say that the bond market now is flattening in the yield curve because of this pseudo-stagflation, peaking growth situation, then reasonably I could draw that back all the way to maybe late May when it started getting crushed. NASDAQ's been crushing it since then. So does that go on forever? I know that's your point, is that it's been the trade, but do we reach a certain point where even these companies ultimately go, you know what, we need the economy too? Or maybe, I don't know, people just run out of cash or stimulus or something.
Well, we've seen many of the NASDAQ stocks get hit, right? Like Microsoft, Apple, Amazon, Facebook, Google. Well, not Google, but all the other companies, they have been hit. And the problem is that when you go into a phase transition, that's where people find safety in these proven companies. So now all of a sudden, Microsoft and Amazon and Apple are going to go from, people are going to sell small cap stocks and sell these, riskier stocks that they've been playing, that they've been making 10 times their money on. They'll sell those in the next phase transition, and they'll go into the big tech names as safety.
So do you think, Phil, that we can, because right now the Russell's been bouncing in this 200-point range, can we continue doing this handoff back and forth and keep it range bound, or will we have one crack? What is your view on how long we can play that sort of hot potato game with the economy?
It is signaling lower lows. The Russell hasn't made a high in a few months.
Do you think Russell's going to break down?
It'll come close to it, but it hasn't. So we are signaling lower lows. We're playing the downside of the Russell. That's our hedge on our portfolios. You can do it with options or futures. You go look at the September options. That'll get you past Jackson Hole. It'll probably get you past that Fed meeting when they think that they might indicate the taper. That would be the first one, is in September.
And so you say you're hedging your portfolio with puts for September?
Yeah, with puts and short futures on, and the CME has launched a great product. They've got the micro Russell, they've got the mini Russell, so you could find something that matches your needs. And I'm not saying hedge the whole thing. You just want to be balanced. You want to be long tech, long gold, long some of these currencies, short dollar, short the Russell.
Okay. Phil, what about the dollar side there? Because we got a big dollar pop out of nowhere, and the closest thing I can tie to it was a slightly hawkish Fed in June. You don't think that's going to last if the situation has more duration here?
Okay, that was one bounce we saw, but rewind the dollar for 18 months, whatever. It's signaled like 6 or 7 lower lows. It went down to a point where the euro was getting too strong, the pound was getting too strong, the dollar was too weak, and they're going to jawbone it back up. But that thing, it didn't break out back to the upside. It went up to 93. It's range bound. So it looks like we are signaling to go and maybe retest the lows on a dollar.
Okay, I think we hit just about everyone there except for one. And I'm not going to let him get a freebie. That's the coiners. Phil, when you use the word stagflation, there's a lot of coiners that are going to get really excited. But is that how it works?
I'd tell you that Ethereum looks pretty good. If you look, that's like one of the best areas for Bitcoin is when we go into like deflation. They find safety into that weakness in many other countries and their equities. They go into Bitcoin as safety rather than, gold is there, but Bitcoin seems to be an easy thing for people to go on. Bitcoin hasn't flipped a bullish trend yet. The Ethereum has. So Ethereum's your better play right now.
All right. Great stuff, Phil. Thank you for the walkthrough. Appreciate it.
Take care, bud.
All right. Phil Streible is the Chief Market Strategist at Blue Line Futures. Always a fun mind to get inside and see where the logic goes.